FOMC day. We have been waiting for this very moment, and literally as we're speaking, you can see the Bitcoin price starting to move. What is going to happen? We've got 15 minutes, guys, 15 minutes until the interest rate decision. We're going to break down what are we expecting, what are the different outcomes, and then remember, Jerome Powell's press conference is at 1:30. So we're going to cover that off. We're going to go through the Q&A together. So I'm going to be with you for at least an hour today. So smash all the likes, get comfortable, guys, get yourself a drink. I'm here in a hotel room. I'm traveling on business, but I've managed to nab a monitor from somewhere. Camera's over here, the monitor's over here. So it's all super confusing. I've managed to get some decent internet as well. But all that matters is we cover off the content. We find out what is it that Jerome Powell does. You guys don't need to see me in HD. You don't need good lighting because we haven't got it anyway. But we need to cover off the content, and that is all that matters. Guys, smash up the like button. As always, don't forget to subscribe if you're not subscribed. And also, if you could take a minute just to share this on Twitter. If you guys are part of the community, share it on Twitter. Share it in your social networks, those people who like crypto. And let's get more people joining this live stream. 73 of you guys in here. Let's hit that like button up. And as you can see, the Bitcoin price is going. Look at that here on the Bitcoin price. Really is pumping down 19,527 there. We've been monitoring this symmetrical triangle breakout. If you've not seen updates like this, where have you been? You need to be in our Telegram. You need to be on Twitter. You need to be on all our platforms, because I posted this literally while I was in the middle of a meeting. I took TradingView, I screenshot it, and I posted it in our Telegram so you guys don't miss these trading opportunities. There's a lot of volatility today. I didn't have any time to trade these moves today, unfortunately, but at least you guys can take these moves and benefit from the volatility. Remember, be very, very careful leading up to an FOMC meeting. Remember to take profits as and when you're happy with your profits, because things can change very, very quickly. Let's see who we've got in the chat. Junebug, good to see you, buddy. What time is the announcement? Announcement is in 13 minutes for the interest rates, and then Jerome Powell speaks half an hour later. So we're going to get the interest rates that shortly as well. Then we get Jerome Powell speaking. I think those latter bits are going to be more important than the rate hike. But so I'm going to explain that very, very shortly. I know everybody's focused on this rate hike, but I need to explain what you guys need to be tuned into whilst we're watching this together. Dr. Moore, good to see you, buddy. Vicky, evening. Are we bullish or bearish? I'll cover that off in a second. Brandon, good morning. Good morning. Evening here. It's almost 7 p.m. here in the UK. Best case says it's bullish. Vicky, hey, hope you're good. Barney, evening all. Sherlock, good to see you. Sheriff Powell needs a hat. Hit the like button, everyone. Absolutely. Broke Boy, good to see you, buddy. Appreciate you. Evening, Maz. Beyond Infinity. You guys are awesome. Thank you guys for joining this. You guys are definitely in the right space. We are going to be covering off the interest rate announcement. So without further ado, what is the market expecting? We've covered this off in the lead up. I don't think any channel has given this the coverage that we've done here in this community. So shout out to you guys for understanding what's going on with the FOMC, why it's so important right now, what the narrative is, and why we need to care as crypto investors. I know it's easy for everybody just to be, moon boys and not talk about this stuff and only talk about it like today, but we've spoken about it in the lead up, understanding exactly what's happening. So you can see 80% of the market is expecting 75 basis points. I personally expect 75 basis points. Most of the market does not think that Jerome Powell has the cojones, has what it takes to rip that band-aid off to do the 100 basis points, even though we all know the market needs it, right? So the market is really not expecting him to do it, and that is why only 20% of the market has priced it in. So in other words, if we get 100 basis points, it's going to be bad. It's going to be rough out there because the market has not priced it in. However, if we see the 75 basis points, we're going to see a bit of a relief pump. Why? Because 20% of the market has priced in 100 basis points. So they need to unwind, which will give us some opportunity to move. Now, on this live stream, we're going to be talking about FOMC. But please do not forget, I updated you this morning. Overnight, the situation changed. We had escalations in the tension between Russia and Ukraine. We've got to be cognizant of that, guys. I know we're investors. It's not a political channel whatsoever, but you've got to keep that on your mind. Once we pass this FOMC, that adds an extra layer of confusion as well, okay? So please be careful. We have to watch that. So that's the first thing, okay? 75 basis points, majority of the market is expecting it. Now, what we also need to look at is this. And again, guys, you're going to have to bear with me because it's not the most exciting thing in the world. But we get a summary of economic projections. And in the summary of economic projections, you get a page like this. And on this page, we want to be looking at this section here, which is their projection for where they're going to take interest rates by March of 2023. This was previously 3.8, and the market is now expecting this to go up to about 4%. So we will look at this, we'll cover this bit off, and we're also going to look at what is called the dot plot. Okay, very important that we look at the dot plot. What the dot plot shows you is where do the Fed officials think the rate hikes are going to happen over the next period of time. So you can see they just put a dot where each person votes where they think the Fed rate should be. As you can see from the previous meeting, you saw that they expected to go up, and then you saw that they expected to start coming back down by 2024. So we'll monitor this as well. But the most important thing is going to be this number here. We want to look at this. Is their Fed rate projection crazy? We'll look at the unemployment rate because they're going to have to price in some unemployment, right? If they're going to increase interest rates and tighten this economy, then it's going to have to, there's going to have to be give somewhere. And that's normally the labor market. So they could be pricing that up to 5%. So this is called the summary of economic projections. That will come out in 10 minutes along with the rate hike. So whilst everybody's focused on the rate hike, which we'll quickly absorb and we understand, okay, is it 75, is it 100? We move on, we look at this and we try to understand, because if this is super high past 4%, I'd expect the markets to be pretty upset with that. If it's within 3.8, 3.94, we're okay. If it's 4%, then we will struggle. Okay, guys, again, sorry if the stream is lagging. Sorry if the connection's not the best. Sorry if the lighting is horrible, which it is. We just got to get through this together and get the content. Guys, don't forget to smash up the likes. Really appreciate you guys. Doug, good to see you, buddy. Rolo K, good to see you. Who have we got here? MJab, good to see you, buddy. Evening from Lithuania. Always like joining your videos. Appreciate you, Abdullah. Sumya, when hike, exactly. Biggest FOMC decision ever, potentially. And the biggest shock will be if Jerome Powell does 100 basis points. What do you think? If you guys think he's going to do 100 basis points, put it in the chat now. I want to see it, and then we'll know who's right in 9 minutes time. Put it here and let me know that you expect 100 basis points. That'll be really interesting. So what I've done is I've gone ahead and set up this. So we've got 5-minute chart of Bitcoin here on the left-hand side. You can see Bitcoin getting a nice little pump here over the last few 5-minute candles. S&P chilling out for now, waiting for this Fed decision. Don't be surprised to see a bunch of people taking profits leading up over the next 9 minutes or so. Normal trading activity. This is what we used to do in traditional finance, so it's very, very normal. Steelman, good to see you, buddy. Yusuf, good to see you. Evening from Cameroon. Chung is in the 100 gang, legend. Andrew's expecting 75. J Dubo 79. From 75. When Nuke says we're okay. Steelman's expecting that full percentage point. Relax your vision. Hey, from India. Hello, sir. Mitchell, hey, mate. Good. Dump or pump from Michael Hayes. We will see. We will find out. Good to see you all here, guys. Please don't forget to smash up the like button. We've got over 171 of you in here, but only 54 likes. So I am a mathematician, but still, we didn't need all that knowledge to kind of figure that out. So yeah, please rectify that for me, guys. And if you don't like the stream, you can always unlike it, which is the power of YouTube. You can, if the stream deteriorates, you can unlike it, but don't unlike it because Jerome Powell starts waffling. Because I can tell you for a fact, he's going to start waffling later on. Dean Ryan, good to see you. Yusuf said he's going to be selling the rip. Justin says he's hoping for 100 basis points. I'll take the dip for a stronger relief. Right, let's go test to see if you guys can hear Bloomberg. Let me know.
In the cycle. And so as our inflation forecast has moved higher, we've had to move up the terminal rate. And I don't think the Fed can rely on forecasts that the inflation is going to come down. I think they really need to get it above spot inflation. In terms of recession, it's become very complicated, certainly with a technical recession in the first half of this year, 2 consecutive quarters. I think from the Fed's perspective, it's all about the labor market. Whether or not we get negative growth or zero growth is almost irrelevant. It's whether or not the labor market.
Great stuff. I think you guys can hear that loud and clear. We've got that ready to go to find out what is the response when they speak. I've also got this ready. This is where we're going to download. If you guys want to follow along at home with your homework, you just want to type in federalreserve.gov. You'll be able to find this page. It looks like this. And they're going to put up a PDF. We'll refresh on the hour. We should get a PDF right here. We should get some projection materials like so. We're going to download it. We're going to quickly read it. And we know what we're looking for. That's a powerful part of being part of this community. You don't have to figure it out alone. We've done it together. We appreciate you, Tanvir. Thank you for being part of this. And yeah, let's navigate. I mean, it's exciting. It's a big day. And as you can see, the markets already took a bit of a punishing going into this. And this is what's interesting, is normally, you kind of wait for the FOMC and then you get a big reaction. We had a big reaction, which is really odd. I mean, this took us down here to the downside and we had that reaction. So now we need to see what happens. Are we going to have further reaction, or 175 basis points, which is the most likely scenario, gets announced? Is that going to be enough for us to get to 20? That's the question. How much of a pump can we get if it's 75? I mean, the one thing we've not discussed is, can he do a 50 basis points? I personally don't think so. I think he'll probably get, taken out if he does that. I mean, that would be horrible if he did 50 basis points when inflation is uncontrollable, but it's a possibility, right? So again, we have to think about that. The market would go absolutely crazy if he did that. It'd be super, super green, and you guys will be trading the heck out of that. So let's see what happens. We've got 6 minutes left. Illuvium thinks 175 basis points. Not a chance, buddy. Not a chance. MK thinks 100 basis points. Relaxed Division's expecting 75, but 100 will bleed the market. Absolutely. Micro Hayes, appreciate you. Cool. So yeah, you got this pattern here on Bitcoin forming. I mean, you got a bit of resistance coming in at 19,700, and then you can pretty much run up to 20,000. So that's your bullish case. Bearish case, I mean, you can see my price target, guys. If we break to the downside, if we come back into this channel and break to the downside, you got 18,700 as support from the bottom of the channel. That's very important. If we lose that, I think we're heading down to 17.5, and that's where I've got some limit orders set to get me some cheap Bitcoin. And kind of longer term, what are we expecting? I mean, we want Jerome Powell to get control of this. We've been in this bear market for a while now. Equity markets have been suffering. Crypto markets have been suffering. Risk has been off. And the reality we now need is we just need Jerome Powell to get on with it. I think that's pretty much where the market is. So even if we get the 75 basis points, it's going to leave a little bit of a bitter taste in some investors' minds because we're just delaying what it could be the inevitable, right? So we need to keep that in mind as well. Let's take a quick look here at the US markets. And you see US markets, NASDAQ up 0.65 on the S&P, 0.25 on the Dow. Not bad, right? Not bad having a bit of green. But the problem is when you have a bit of green going into FOMC, it's just the froth that just drops like a rock afterwards. So not buying too much of this green, bunch of trading activity. No doubt, I think they'll be taking profits within the next few minutes here leading up to the FOMC. So just watch out for that. You'll see some profit taking for sure. Fear and greed index sits at 23. You've got your US 10-year still above 3.5%. So yeah, still tricky times in the market. So let's go ahead and leave this chart up. And we've got 4 minutes or so. Steelman, got to get back to work. Have a great day, everyone, and always tune into charts. Appreciate you, Steelman, for jumping on. Don't forget, we'll be here for over an hour or so. We're going to cover this rate. Then we got a half an hour to digest that until the press conference from Jerome Powell, which is going to be the important bit as well. So we'll be covering that off. So definitely check that out. Appreciate you. He says it would make sense to do 100 basis points or higher and get the job done, but I don't think it will happen. I think that's where the market's at, guys. That's where the market's at. They don't think it's going to get done, and that's part of the issue. Jason wants to, oh, man. Okay, cool. So let's just one more time cover off what are we expecting. So when you get these readings in the next 3 minutes, you want to look at what are they moving the Fed funds rate. So if we see 3 to 3.25, that means they did a 75 basis point rate hike, okay? If we see 3.25 to 350, that means he's done 100 basis points, okay? So that's what we're looking out for, is when we download the PDF, we're all going to panic and rush and look for that number. That is what we're looking for, okay? So really important that we look out for that. Another interesting thing, whilst we got a couple of minutes here, is I was looking at this, which is the interest rate set by country. So you can see US is sitting here at currently 2.5. We could be going up to 3.25 today. Again, super far away from many other economies. I mean, the kind of economies you've got ahead of you here, China's at 3.65, Indonesia 3.75, India at 5.4, South Africa with a rates of 5.5, Russia at 7.5, obviously given what they got going on, Mexico at 8.5, Turkey, Brazil, Argentina, we know they're suffering with inflation, super high interest rates. I mean, Argentina at 75% rates, insane. I think 75 base points is the expected case, right? The majority of markets expecting that 75 basis points. So it's going to be a case of maybe moving sideways to having a slight pump. The question is, how much of a pump can that be? Can we get back to 20,000? Can we get beyond there? Because I think, the market's going to have mixed emotions with 75. I think they'll be happy that it's not 100, but at the same time, they're like, oh, Jerome Powell's a bit soft. What's going on? Like, the market needs somebody to discipline them, right? And Jerome Powell's not done that today. So that's part of the concern. Cool. Let you guys, let me know what trades are you placing right now. Any of you in a trade right now? Have you closed your trade? Are you looking to take one? Drop it in the chat and let's see what you guys are planning on doing. In the meantime, we've got 1 minute to go now. So looking forward to that. We'll get ready now to pull this up and start refreshing, which is what I'll do. Let's Okay, so let's pull this up and we'll start refreshing here and see when do we get it. So we got about probably 30 to 45 seconds before this comes up here. And we want to see what do we get, guys. Let's see. You guys might get it before me, depending on which servers you're on and how fast your internet is where you are, but I will be refreshing. Never gets boring, does it? The old FOMC meeting. Some of you on 100x leverage long on Doji, legend. Right, stop disturbing me. I need to refresh. I've got an important job right now. Oh, my clock says it's on the hour. Let's see. Not getting anything yet. Not getting anything. Come on. Come on, Jerome Powell. Press upload. There we go. September PDF, 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 PDF. Page not found. I was too quick. Come on. PDF. Useless FOMC. There we go. What we got? What have we got? 3 to a quarter. 75 basis points, guys, as predicted. We have got our 75 basis point rate hike. Let's take a look. How is the market responding in a big fall? This is interesting, guys. This is what we were just talking about just now. So the market's like, why are you being so soft? The market doesn't like it. It's like, why are you being so soft? Remember, this is the one we're looking at, 3 to 3 and a quarter, and that's officially what we've got here. Okay, that's officially what we've got here. So you can see here, committee decided to raise the target range for Fed funds rate to 3 to 3/4 and anticipates that ongoing increases in the target range will be appropriate. Okay, so now we're gonna have to pay attention to see what happens here in the market. Market's not so happy right now. Bunch of people taking profits. Traders do this, right? Because they want to stay in their position when the announcement comes and quickly take their profits and they want to get out. So let's see how we get on here. How much do we fall? What do you guys think? A lot of you were expecting 75 basis points. I know I personally was expecting 75 basis points as well. But now that it's happened, what is your feeling? What is your feeling around this? Do you think Jerome Powell should have just got on with it? Are you happy that we don't have 100 basis points? But yeah, he definitely left his pair at home. And huge wick to the downside here. Bitcoin back below 19,000, 18,900 here on Bitcoin. SPY is literally falling, 383 on the SPY. And yeah, this is 100. Yeah, so we'll have to monitor this now to see what happens. We'll also see if we can take a look at the summary of economic projections. Let's do that. Have they put the PDF? Maybe they do that later. Okay, there we go. So we've got summary of economic projections. And I want to quickly come down here. There you go, guys. This is what's also spooking the market. What did I say? That needs to be at 4, put it at 4.6. In other words, they're saying we're going to hike for deeper into tightening territory. Okay, this is not good for markets. This is much worse than just a 75 basis point rate hike. This is what people don't understand. They just look at the headline. Oh, it's 75 basis points. Why is the market moving down? This is why they put their uptick on unemployment to 4.4. They didn't go crazy. I was expecting maybe that could go up to 5, and then they've got it coming down in 2025. You can see for inflation, they expect it to top out here, PCE inflation at 5.4, and then come down significantly with 2023 getting close to 2%. Okay, core inflation, they think it will remain at 3% throughout 2023, but this is the bit that's hurting. This is the bit that's hurting markets. 4.6% there for the Fed funds rate. I did mention that before in the preview, and you can see this is what's causing it right now, guys. So hopefully that makes a lot more sense of why we're seeing this action in the market. And this is some serious downward action right now here on crypto. The market's just really nervy right now. What Jerome Powell has just said is we're going to hike for just longer, but deeper. We're going to go even tighter than previously expected. Remember, the previous projection wasn't as deep, and now it's gone to 4.6%. 4.6% here. Okay, that's the number I'm referring to. That is what's causing the upset in the market right now. So let's just keep that chart open here. Let's just monitor that for a second. Let's also turn over to Bloomberg.
Let's just pick up on sterling as an example. 112 handle, 112 handle going into the tomorrow, 112.50 right now. That currency pair with a 1% move.
I would say the word plunge.
Look at the dollar index, guys. They're showing the dollar index.
International economics, folks.
Bitcoin down.
Moves are very small but very important. Maybe only yen at 144.48 is there, but sterling is stunning. Euro even more so, I would say. It's just all of these moves and these dialogues change the game for the governor tomorrow with the Bank of England.
The 4.6 is your dot, Bramo, for 2023.
It matters for markets. What you're seeing is a very hawkish 75 basis point hike, and that is basically forecasting there is more to come, and they are willing to take pain in the economy, and the market is responding.
Yields up some 13 basis points on 2 years.
There they are.
Big move. Let's see if it sticks.
After an already big move.
Yeah, let's do one more look here at the data. I think it's so important on the fixed income market. The 2s10 spread a pre-immiserate negative 50 basis.
Just while he's doing that, guys, let's quickly go and look at what they were talking about, which is the dollar index. Remember, dollar index, we constantly monitor. We need that to come down, but it's not. It's spiking on this news, right? Obviously, any fear, any of that kind of thing where you're worried about a global slowdown or persistent inflation, dollar index thrives off of that. It's moving to the upside, as you can see right there. That's causing risk-off behavior. Bad for NASDAQ, bad for S&P, bad for crypto. That's what we're seeing right now. And again, Jerome Powell coming out, and Fed officials more importantly coming out and saying, we're going to be aggressive. This is called a dot plot. What we're looking at here is a dot plot. Remember, every Fed official puts a dot on where they expect interest rates to lie by each of these timeframes. You can see here for 2023, the majority of people ask, if you take the median, you're at about this 4.5 to 4.75 range. Remember, we're only just now at 3 to 3.25. Okay, so that indicates another at least 1.5% there to go. So there's no chance of this pivot happening just yet, because it's still got some hiking to do well into 2023, and that's what's causing the upset here in the market. Is that exact point that Jerome Powell's going to continue to be hawkish. Remember, when he did his first 75 basis points, he was like, oh, this may not be, very frequent. This is a big rate hike. But again, he's done 3 of them in a row. There's no clues that he might not do the same again in the next meeting. If inflation doesn't come down, he probably will have to do the same, if not more, in the next meeting. And he really is on the back foot, in my opinion. But markets are obviously upset at the fact that he's going to have to continue to hike, and hike quite powerfully.
More of a look at the data as it comes in and wait for the inflation data to fall.
These forecasts previously, Rich, and good to see you, by the way, but
yeah.
It's been a while. They were called aspirational, fanciful. We've now got an unemployment rate in their forecast for 22 at 4.4, for 23 rather for 4.4, for 24 at 4.4%. Do you think they've ripped the Band-Aid off just yet, or are they doing it slowly still?
I wouldn't say it's ripped off. I think but the contrast with where the committee was in March, which was what I've called the immaculate disinflation, with no rise in unemployment, no fall in growth below trend. So I think this is recognizing that, as the chair said, some pain will be part of disinflation. My own personal view is it probably will be more than the rise indicated by the dots, but I think it is acknowledging that the disinflation is going to cause that pain.
So the risk is to higher unemployment, to even higher Federal Reserve rates off the back of this, you think?
Well, we may not need higher Federal Reserve rates look off this year, and I guess another 20.
Guys, make sure you stay tuned. We will be covering off the press conference. Remember, the press conference historically has always moved the market much more so than the rate decision. Obviously, we're seeing the markets move already, not just because of 75 basis points, but by the fact that we also have the summary of economic projections showing that they're going to be hiking up towards that 4.6%. So, oh man, indeed. Worse than we were expecting here today. Yes, we didn't get the 100 basis points, but the summary of economic projections has come in pretty bad. And now we need to see, what does Jerome Powell do? I think Jerome Powell's going to have to come out strong now, because he did 75 basis points. He didn't do 100 basis points, right? The option was, if he went 100 basis points, he could be a bit soft in his press conference. But now he's gone for the 75 basis points. He can't be soft again. Remember when he was soft earlier in July, markets decided to run and had a brief summer rally, right? So he's got to come in. He's got to keep his foot on the market. He's got to bring inflation down. It's going to be a tough press conference again. I don't think he can let loose and be soft. Which means further pain here in this market. So we're going to monitor that together, guys. In just over 20 minutes, we'll have that full Q&A right here. So don't forget to smash up the likes and let's watch that together. Get yourself a cup of tea or coffee. Make sure I'm on your big screen, and let's get through it.
And just assumes core, well, all of our listeners and viewers are assuming the crushing burden of real inflation.
Although real inflation, or CPI headline inflation, has been coming down, and the fear is that the core has continued to go up. Are you concerned that Fed policy doesn't have the same muscular effect on markets, on the economy as it used to, with a lot of it insulated with corporations that have termed out debt?
Yeah. I think there's an element of that. Milton Friedman, very, very quotable, one of his quotes was monetary policy
Just had a question here. Can you explain in elementary level the Fed's fund rate 4.6 you were speaking on again? Yes. In other words, what this is, let's just go back to it. Let's go through this together. So what this is saying is, what is our Fed's federal funds rate projection? So they're saying by 2023, we want to be at on the 4.6 level, okay? Now, what that means is you can currently see where we're at. We're currently just hiked. We've just had that. So we're at 3 to 3.25. Now, at the previous time we had the projection, this was 3.6. In other words, which the market thought we were nearly done, right? One more hike after this one, which takes, we're at 3 to 3.25. One more hike would take us to, 50 basis point hike would take us to 3.5 to 3.75. That's in their range, because they said 3.6. So we would have been done. Now they've upped it to 4.6, which gives you more rate hikes and means that the Fed still wants to keep going further into tightening position. Remember, 2.5% is considered your neutral rate. So before that, before we got to 2.5 a couple of meetings ago, we were in a accommodative situation, which means the Fed overall was still helping the economy. Overall, they were still printing more than they were hoovering out the economy. Now, just before this, you're at this break even, right? Where you're hoovering out as much as you're printing. So you're kind of at this break even. Then you start entering this tightening position, okay? And the tightening position ends up being about where we're starting to get to now, possibly in the next meeting, where you start to see the market really starting to tighten, which is where overall you're hoovering up more money than you're printing into the economy. That is how you bring the inflation down. Now, there's also something called the terminal rate. And the terminal rate is what is that rate you're going to get to before you pivot? And that is what the market's focused on right now, is what is that terminal rate? Is it 4.6 now? When you get to 4.6, are you going to stop and start rotating and pivoting? That's what we want to know. What is the max that interest rate is going to be before we can start pivoting and getting some cuts in play? Hopefully that explains it, Lefty. And let's get back into Bloomberg.
Last year it was so substantial, and it's turning out to be so persistent that I think the risk is, and also because I think there's less faith in some of the models, it is really going to be more focused on actually getting tangible evidence of a durable decline in inflation. And what that does mean, related to your question, is that it does mean the risk is overdoing it ex post. But I think if you look at Fed...
That's absolutely right, Ian. That's exactly what we were speaking about beforehand, which is the markets. They're happy with the 75 base points, but they're not happy. Because it's like imagine you got this parent and you're growing up and this parent keeps giving you sweets and chocolate. You're happy because you got the sweets and chocolate, but it's like, does my mom not care? Like, do they not care about me? What's going on? So it's almost like this thing where the market is having to be the parent when Jerome Powell needs to be the parent. He needs to set the course. He needs to set direction. He needs to be firm and rip that Band-Aid off. And the market is really starting to get frustrated. But also, like I said, it's that summary of economic projections which is really causing the redness in this market. Dollar index climbing. We're seeing a little bit of the blood stopping here at this 19,000 level. But let's see. Again, we're going to have to wait for this press conference because normally this is just the trading activity around the interest rate hike, and then you find out more of what's on Jerome Powell's mind when he starts to speak in the next 15 or so minutes. We're looking forward.
Really believes in these numbers going forward. When you look at the 2023 dispersion, and it's still tightly bunched, but it's 6 to 6 over a 25 basis point move, and then 2024 and 25, it just all falls apart. I'm wondering if, given the fact that there are no models for what we're coming out of, that we should put much stock in what the Fed thinks is going to happen next year, let alone 24 and 25.
Well, I certainly agree with you. The further out the forecast goes, the less confidence in general you should have in it. On the other hand, I think the dots are, again, just processing it now, I think the dots are conveying the determination of the committee under Chair Powell's leadership to move policy into what they think of as a restrictive territory. And I do put a lot of weight on that. The economic forecasts are obviously dependent also not just on policy, but a lot of other factors. But I do put a lot of weight on what the dots are trying to tell us right now.
I think I agree with you, Rich. We've got to look at the front end too. It's not just about 23. I think my focus coming into this was where's 23, where's the terminal rate? I didn't expect to see 22 at 4.4%.
I didn't either.
4.4%. Think about the work we're doing here through this year so far and where this Fed was in December of last year. In the summary of economic projections, Lisa, in December of last year, and we've talked about this a few times, the Fed had year-end Fed funds at 90 basis points. And now it's gone to 4.4%. That's a major change.
It's an about face at a time when they are saying that forward guidance is dead. It is very not dead.
It's
it
very
is so
not
alive.
dead.
I mean, this is basically them resurrecting forward guidance and saying, here you go. And our guidance is we're going to hold rates high for a very long time.
Yeah, exactly.
There you go, guys. That's what's upsetting markets. That's ultimately what's upset. She summed it up pretty well there. That is what's upsetting markets, right? The hope in the markets when you're running up to that 25,000 on Bitcoin just a couple of weeks ago was that the market, based on Jerome Powell being a little bit soft, decided to they told themselves that he's going to be done. He's going to start pivoting. I remember a lot of crypto influencers were tweeting, that's the last 75 basis point rate hike we're seeing. Yeah, no, we're not there yet. And that's the important thing. He said very clearly, you guys can do what you want, right? You guys can follow whichever YouTubers you want, and you guys can listen to them when they say we're done. But I'd rather listen to Jerome Powell. And Jerome Powell said, we are not going to change our stance until we see meaningful improvement in CPI inflation. We've not seen that, right? We had one reading come down. The last reading was the second one, which came down the first time we've had two consecutive coming down. But it missed expectations. CPI still rose month on month, right? So it's still an issue. It's still there. And we're now moving into this place where we're not just raising rates to neutral rates, we're actually going to tighten. And that's a big difference, right? Going from accommodative to neutral is one thing, and then going back to accommodative, which is what the markets were hoping for. But now he's going from accommodative to neutral to tightening. And that is the bit we've not seen seriously for a while. And that's what's causing the pain here. Is this not a quick fix right now, right? Jerome Powell's missed the opportunity for a quick fix, soft landing. That's not happening. We're going to have to do this the hard way, and it's going to be painful interest rates for a while. And we need to react to that. We need to respond to that. We need to be prepared for that. And we need to have a game plan. Don't put burying our heads in the sand saying, no, it's going to get better. Like inflation's going to get better. And then he's going to start pivoting at the next meeting. No, get your game plans right. Be prepared for this type of market and know what to do in this market. That's the key right now.
Are more relevant for other economies than they are
Yes.
for the U.S. because the U.S. is relatively close. So big moves in the dollar don't really move into U.S. inflation very substantially. There's something that some folks, including Maury Oakesfeld, have called a global dollar cycle. I think thus far I've been pleasantly surprised how well the global economy has happened to a really hawkish pivot by the Fed, but obviously something that'll need to be followed.
But if you take a blended index, Bloomberg dollar index is a good idea. And there's emerging market ones, you know better than me. If you take it log, so slope matters, the answer is these are not smooth curves. The reaction function of any central bank, including Fed, take the Thai central bank if you want as well, but the reaction function they have is not linear. There's a point where it's a jump condition or a kink or a change. Are we close to that?
Are we close to that? Well, I think depending on how you interpret today's move, we could be close to
DXY 111.36, yen 144. That's a fiction.
The other thing what I've noticing, guys, is this. Okay, so I've just got the previous summary of economic projections they shared in June. This figure here was 1.7. So GDP for 2022 they projected as 1.7. Okay, so that's been revised down to 0.2. Then for 2023, they had 1.7. This has been revised down to 1.2. For 2024, they had 1.9. They revised. They're expecting less GDP growth. Unemployment, they started notching that up slightly here, 3.7 to 3.8. For 2022, they've notched that up from 3.9 to 4.4, and then 4.1 to 4.4 for 2024. So they are showing that unemployment's going to have to tick up because they can do more of these increases in interest rates. Okay, so that's something that we need to be aware of here. And again, I know it's not the most fun of stuff.
We did see a revision in some of the unemployment rates, as well as just how long they'd have to hold rates high. Do you think that this is going into the realm of reality?
It's still not quite there, and I think Rich is exactly right on that. I think the key issue to really lock onto in this is something, a point that Rich made, that core inflation is looking sticky. The Fed had confirmation bias with the CPI that came out confirming its worst fears, and that is inflation is more inertial. This is something we're also seeing in surveys of businesses versus surveys of consumers. Our own internal surveys, which we hope to publish soon, are showing that businesses.
Okay, so we got 10 minutes or so before Jerome Powell comes out for his press conference. So I can see you guys having a bit of a discussion around how low can we go. So why don't we take a look at the charts and actually try to figure this out together? Because it's an interesting conversation. And this is one of the conversations where it's important to be very rational. Okay, so I'm going to try to be rational here and show you through price charts and patterns the different targets that are possible. Instead of me just spitting out numbers, like anybody can spit out 10,000, 12,000, 30,000, let's actually look at what the charts are showing us. So let's walk through these. And again, no bias to any of these directions, but just saying, let's see what we can see. So I'm on the daily chart now. And the first thing we can see right now, very obvious, I don't think anybody can complain with this, is that 18,700 is in play, right? It's the bottom of the channel. We bounced from there once. We tried to bounce from it again. That's in play. I think it's then very, very safe and not crazy to suggest that 17,500 range is in play, right? That's the low from this period, dating back to the 18th of June. I think it's safe to say that's in play too, okay? I don't think anybody's going to give me any stick in the comments for those price targets. Then it starts to get a little bit more interesting because If you take the breakdown from this type of symmetrical triangle, which we were looking at, that brings you down to a price target of a little bit lower at 17,000. Again, not so crazy, but at least we got a technical target, which shows us that that's potentially possible, right? That we can get to that kind of a level. So we'll keep an eye on that as well, 17,000. Then you've got some horizontal support at 16,240. So that's the other level we need to look at. Now, for those that are shouting out the price targets of 12, 13, I guess we have to ask ourselves, what pattern are we using to define that, right? Are we using a pattern? I mean, you can look here. Technically, you can still say we're still on track for this weird kind of a W pattern. It's possible, right? I don't think the macroeconomic conditions are going to allow that, but it's possible. Then if we look out to see, okay, what is the next really major level support zone? And you've got to ask yourself, the bit we're hanging at right now is the high from the previous cycle, right? December 7th, 2017. Okay, that was that peak there at 20 before we fell all the way back down to the 3,000-4,000 range, and then we worked our way back up. And the next support level you get is exactly on that rise. Because what happened is throughout 2019, you had this rise culminating into a peak at about 14,000. Everybody was getting excited. They thought Bitcoin was off again. And it went up to about 14,000. And then we fell back down again, all the way back to 4,000. So that's an important level of support. If we lose 20, which would be ugly, you've got major support at 14,000. Okay, so those are the levels we're working on, and I don't think it makes any sense for us to go lower. We can analyze lower, and there's the next price target at 10,000. But for now, there's plenty of support there for us to work through. And the analogy I'll constantly remind you guys of is when you've got asset classes, moving the first bit from all-time highs down is easy. Moving the next bit, still pretty easy. Moving the next bit gets a little bit harder. When you retrace 80% in the market, when you've had these difficult bear markets where plenty of people have had time to short, plenty of people have time to accumulate, and it's not a surprise, then what happens is the elastic band's harder to pull back. Everybody thinks, oh, of course we can retrace another 20%, 30%. Why not? Not as easy, right? It's like losing weight. If you start off from a very heavy base, the first couple of kilos is fairly easy. You lose them pretty quickly. Then it gets harder and harder the leaner you get. Bitcoin is very lean right now compared to the hash power and the network that it is, the network of miners. It's hugely undervalued relative to where it's been at all-time highs. So it's harder and harder. Anybody who says it's just going to cut in half now from 20,000 to 10,000, that is not as easy as going from 70,000 to 35. It's not. It's much harder. So it's really important we keep that. And if we do go those levels, fantastic, right? That's where you have to test your conviction. Do you have that conviction? And if it doesn't, then it's fine, right? Being crypto since 2013, I've earned my medals obligatory. Trust me, bro, by me, this ain't going to 12K. Yeah, I think a lot of people have been in quite a few cycles, don't believe it's going to go to 12K. My view is 17,600. I've said that for a while. I'm then looking at some of the next price points. Remember, between about 13, 14,000, you get the delta price. I'm going to do another video when I get back to my studio. I will be doing an on-chain analysis. It's been a little while since we've done some on-chain metrics. And I will show you guys where the realized price is at, where the delta price, where the balance price is at. We'll look at those as potential bottom support models as well. So we'll be looking at those as well. Right, guys, 5 minutes until Jerome Powell. What do you guys think? Is he going to wreck the market more, or do you think the market's done for today?
Both in terms of economics and in terms of what they communicated, the committee is going to really need to push back against this idea that they'll do all the heavy lifting this year to get the rates up, and then immediately at the first sign of a slowdown in the economy, which is part of the plan, that they would cut rates. And it was striking to me coming out of the July meeting how some of the more dovish members of the committee pushed back against that. And I would imagine the chair will have an opportunity in 8 minutes. He'll get that question. But yes, I think, in terms of market pricing, I think markets will continue to romance a U-turn by the Fed, and I think they'll be proved wrong.
John, I just saw the dot plot from Brian Chaput, our wonderful bond guy, Bloomberg Opinion. I'd never seen a dot plot like that. It is a mess. It looks like I don't know how to do that. It looks like pickup sticks. It looks like pickup. Were you going to?
So what he's referring to is this dot plot, guys. Okay, this is really messy. Normally it doesn't look like this. They're a little bit more spread out, but it's very aggressive here. In other words, a lot of the Fed officials are being very hawkish. They're almost telling Jerome Powell, come on, let's do it. And they're voting with their votes here. And you can see a lot of people really want to hike up towards 5%. So 1, 2, 3, 4, 5, 6 people here want to be at 5%. Another 6 want to be just a quarter away. And you can see where the bulk of them are here in 2023. So 2023 doesn't look like it's going to be the smoothest in terms of accommodative monetary policy. And that's why we're seeing pain. That's why we're seeing pain in the market. And I think everybody's going to get a reality check, those that are new to crypto, but these things don't recover overnight. If you've seen any previous bear market, it takes time. People really get pushed out of the market. I got pushed out of the bear market, my first bear market in crypto. Right, I did really well, and then held through the bear market, and then got disenchanted because it just took too long and it was boring. And I went back to my traditional finance and asset classes and trading, my other stocks, and you forget about crypto. Then it rises again like a phoenix. You're like, oh my god, why didn't I just stick with it? And that's crypto. That's the roller coaster of crypto. But this isn't just crypto right now. This is the wider markets, and that's the important thing to remember right now. Crypto is not falling alone. Right, so you guys don't need to, it really does give your conviction some peace. This is the blue chip companies. This is U.S. stock market, apparently the best stock market in the world. This is that suffering in a bear market, retraced severely, right? Seeing this red candlesticks. So that should give you a little bit of peace, I guess. We're seeing a little bit of a bearish continuation pattern here, a bit of a bear flag going on here, which you guys can monitor, which is where you get this, and you get this kind of little flag here. So we'll monitor that here in the short-term time frame. At 5 minutes, are we going to have our next dump to the downside? Remember, the next 5-minute candle will be the first one that Jerome Powell starts speaking on. So we'll keep that open as well. Any last questions before we get ready for Jerome Powell's Q&A? Because we cannot disturb the masterful Jerome Powell once he starts speaking. Ali's asking how much points rate hike. We had 75 basis points, guys, 75 basis point rate hike. But more importantly, the summary of economic projections came in with a Fed funds rate for 2023 high of 4.6%. Okay, so that's what the market is reacting to. And now we await Jerome Powell's press conference to see if he's hawkish. Is he a bit soft? I don't think he's going to be soft, guys. I think he's going to be firm. And I don't think he's got a choice, right? He didn't do 100 basis points, so he can't afford to be soft. If he wasn't soft with the rate hike, if he wasn't strict with the rate hike, he at least has to be strict with his words, right? Otherwise, the market's just going to hate him. Guys, don't forget to smash the like button. We're still under 200 likes, which is hugely disappointing considering I'm in this hotel streaming an FOMC meeting. I'm going to have to listen to Jerome Powell for half an hour here. So if you could hit the like button, that would be hugely appreciated. Sean Zero says same thing. Got bored and sold my ETH just before the last bull run. Boredom is the enemy. It is. That's a very important point you make, and that's what we're talking about here. It's that disenchantedness. A lot of people have got stung by that, including myself. You just kind of think, oh, I'll go do something else, right? I could be working on a business. I don't think crypto should consume you, but just keep it in your mind, right? Spend a little bit of time on it, watch a little bit of content, know what's going on, keep your investments going, keep your DCA going, keep your conviction built. That's the important thing. 3 minutes away from the Jerome Powell press conference. 3 minutes. Guys, these officials are doing amazing. There's this report out. I'll see if I can dig it out, showing the number of US officials and their trading success. I mean, it beats Warren Buffett hands down. So it's insane. Powell's a big ApeCoin guy. Digital D, appreciate you, man. Appreciate you being part of this community and supporting. Keep up the good work, big man. Appreciate you, Adam. You're a legend. Cool. Let's see what Bloomberg is saying, and let's get ready for the press conference.
Damage, and obviously, depending upon the country or countries, and the repercussions from that, that would be one area. One thing I would say, though, is we went into the pandemic with the financial system in good shape, and obviously, households have about $2 trillion in the aggregate in saving, and so there are a lot of cushioning elements to the picture right now. But I guess if there is a wild card, it's probably a rate hike cycle impinging somewhere globally that's not obvious right now.
Our currency, your problem, seems to be the focus at the moment.
John Connolly.
When does it become our problem here in America, for this Fed specifically?
Well, it obviously becomes a problem if it becomes systemic globally and leads to a sharp global downturn and all the consequent elements of that. And of course, everyone's hiking. Almost everyone's hiking now, except Mr. Kuroda in Japan. So we've got a global hiking cycle. Remember, in the last cycle, the ECB never got to zero, let alone off negative. So this is a different dynamic, and that just elevates the risks.
Lift the veil on what's about to happen here. Does the chairman have a smartphone in front of him with the S&P 500, the Nasdaq on
I don't.
yield spreads?
Not that I know
of what's moving.
Not that I know of. When we had our meetings in person, the meeting would end, and then the chair would prepare. But I don't think so.
Tom, do you think that would help the chairman? if you could see what the NASDAQ was doing on decision day.
He's on Greenspan. Greenspan would really care. Greenspan really cared about chapter 23 and Name Your Basic Textbook, and he really cared about financial markets and markets. I haven't seen that from Jerome Powell.
Because this equity market is ripped in these news conferences. I tell you what, the way it works around this table is that Lisa often looks over at me and looks at the equity market and says, what's happening here?
Yeah.
I do not get this.
Yeah, well, and that's, I think, the question that I would have for him is right now, is he happy to see the market reacting the way it is?
I'm going to jump off of Richard Clarida and say, to me, he is central banker to the world. I think of Ecuador, 1998 and on.
Guys, you have to remember, redness in the market without Jerome Powell having to do the aggressive interest rate hike is a freebie, right? If Jerome Powell needs to reduce demand in the economy. He needs redness in the market, but he wants to do so without increasing interest rates. So if he can scare markets and if he can get them to do it without increasing interest rates, that could be his strategy. Okay, so that's called jawboning. So definitely something for us to keep an eye on. Is he trying to do that? Is he trying to get the markets just do the work for him, bring things down, get it to a grinding halt to bring inflation down, and that way he doesn't have to create crazy unemployment. Let's switch straight over to him now, and we've got Jerome Powell. If you get bored, not my fault. Still hit the like button.
Of the Federal Reserve after a 75 basis point rate hike.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained and there very likely be some softening of labor markets. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our question. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. To achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So
that's key, guys.
We'll be looking at, I guess,
you want to go into restriction and keep it there for some time.
We're looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear and you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time. And I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly, in my view and the view of the committee, there's a ways to go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect. Because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads, you look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests
base. So how is he going to split that up?
We're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still strong for this?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to, and we're still discovering what that level is. But people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a 10th higher than 2%.
Okay, just as a quick follow-up, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yes, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to, you can't really, you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. But that's how we think about it.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing.
The market's calling his bluff, guys. The market's calling his bluff. We'll do a summary at the end. But the market's definitely calling his bluff.
In other economies around the world and what that means for us and vice versa. For the forecasts that we put together, that our staff puts together, and that we put together on our own, always try to take all that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Great.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing. where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. It's just, and we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that a period of what I mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, and if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris, Rugaber.
Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, You've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
All right, guys, let's wrap that up there. Then I can't listen to any more power. But look, we've got a 75 basis point rate hike. We can see the markets moving green now. Dollar index now crossing to the downside. If you take a look at this, if we bring out our hourly and look at it. But please, please, please do not get too super excited here in the market. That's why he's speaking. But let's remind ourselves of the bigger picture. And the bigger picture right now for us to focus on is the Fed officials have come out hawkish. Their expectations on this dot plot are hawkish, that we need to get to between 4.5% and 5% here in 2023. We now have a new Fed fund 4.6% in 2023, up from 3.8%. This is affecting the markets. You can see the markets are now pricing in another 75 basis point rate hike for the next meeting on November the 2nd. Okay, so that's just over a full month away from now. You can see the Treasury yields continue to be up above 3.5%. And again, you can see the US markets are now green, 1.14% on the NASDAQ, S&P up 0.86%. And Jerome Powell just saying the same things that he has been saying, right? He's saying that he needs to see inflation come down meaningfully. He's expecting lower GDP growth below trend. He's expecting labor market to soften a little bit. He wants it to soften a little bit. But the reality is he didn't come out strong. He still wants the market to do his work for him. He didn't come out. He didn't do the 100 basis points. He did 75 basis points and backed it up with some strong words. So we know where we're at in the market. He's going to have to get to now what is tightening policy, right? Restrictive policy. We were just moving from accommodative to neutral. Now he's confirming we're going into restrictive, and we're likely to stay there for a while. More about what this means over the next up and coming days on this channel. Make sure you guys have hit the like button. Don't forget to subscribe. If you traded this move successfully, then congratulations. But please be careful with the rest of the day with the volatility. Hope you guys enjoyed this live stream. If you appreciate it, me bringing you this impromptu live stream with some random bunch of settings. I don't know where I found this monitor, but I managed it to get this live stream going for you guys. Hope you smash up the like button. Get me to at least 200 likes here before ending the stream, and I'll see you in the next one.